Welcome to CEF Insights, your source for closed-end and interval fund education, brought to you by the Closed End Fund Association. You're listening to a replay from the Advisor Summit on closed-end and interval funds. This session on interval funds is moderated by Jeff Margolin, Senior Vice President and Closed-End Fund Analyst at First Trust, and features Philip Bauer, Senior Vice President and Portfolio Specialist at Calamos Investments, and Nicholas Halbut, Managing Director, Portfolio Manager, and Director of Research at Future Standard.
Thank you, everyone, for joining us today. We have two great panelists. It's a very timely panel. The official name is the Interval Funds, Finding Access, Income, and Diversification. It's a topic that has been getting a lot of attention recently. In fact, just last month, Ignites had an article indicating that there are 288 interval and tender offer funds now in the market, including 46 that have launched in the past year. That's according to data from XA Investments. So roughly 16% of all the interval and tender offer funds were issued within the past year. So clearly, it's a structure that's getting a lot of attention now from investors and advisors. And so very pleased to have two experts in the space, Phil Bauer, who was a Senior Vice President and Portfolio Specialist at Calamos Investments, and Nicholas Halbut, who is a Managing Director, Portfolio Manager, and Director of Research at Future Standard. So thank you to both of you for joining us today. But my view is the less I speak, the better, because we really want to hear from both of you. So let's get right into it. Phil, we'll start with you. What are the major differences between the interval fund structure and tender funds or even BDCs? And from your standpoint, what are the benefits and drawbacks of the different structures?
Yeah, thanks, Jeff. And it's a good question to start off on. And so I think the easiest way to think about it is that an interval fund structure, and the reason why you see this massive uptake in its use, is that you can think of it as being the same as a mutual fund in pretty much every way but one. And so when you think about the interval fund structure, it has a ticker, right? You can subscribe to it daily. Okay, so that ease of access and the ability to come into a RANT portfolio is really nice. Okay, it has 1099 tax reporting, okay, and versus a K1, which is what you typically would have to do to get access to these types of structures. But the one big difference is that you don't have daily liquidity, right? So for a mutual fund, you can sell it on any specific day. With an interval fund, you typically, for credit, it's quarterly. For private equity, it could be semi-annually, but there is a liquidity constraint. Now, with that, you get to invest in less liquid assets without there being an asset liability mismatch. And so you basically get the benefits of investing in a BDC or tender offer fund, except for the fact that you don't have to fill out subscription docs, there's no K1 reporting, and you get to invest on a daily basis. And so that is really why you're seeing this massive uptick in both accessibility and use, because it's much easier to plug in an interval fund into a portfolio model than it is a BDC or a tender offer fund, or obviously a drawdown fund, right? Historically, to get access to the private markets, you would have to invest in drawdown structures, LPs, where you were, in general, limiting any type of liquidity for 8 to 10 years. So the interval fund structure, I think, has been a nice tool for the wealth management sector to get broad access to institutional quality investments on the private side.
Yeah, thank you for kind of setting the table for us with that description and explanation. Very helpful. And I want to switch now to Nicholas at Future Standard. What makes the FS Global credit platform unique from your standpoint? What differentiates Future Standard in that middle market credit space that's been getting so much attention recently?
Yeah, great question. So, Future Standard is an $86 billion alternative asset manager. Within the broader firm, my partner and I run a business called Global Credit, which is about a $9 billion business. The two of us have been working together since the early aughts when we met at Goldman Sachs in the Special Situations Group, where we invested the firm's proprietary capital in a broad mix of credit strategies. So essentially, we've been doing this and working together for over 20 years at this point. We have a 26-person investment team supporting us with 12 managing directors. That should grow to 29 by the end of the year. We really focus on the lower middle market, and we're focused on a mix of credit asset classes, predominantly private credit, but we opportunistically add risk in the public markets to enhance returns. That's really event-driven style opportunistic investing. The business is a mix of sponsor and non-sponsor based lending. It's predominantly first lien. And I think importantly, our interval fund structure offers access to our proprietary capital structure solutions deals, which my team and I are putting together to provide transitional capital to investors, or rather companies that are looking for solutions that are, going to be expensive, but less expensive than raising equity. So these are mid-teens or higher, structured solutions, that we're working on to help businesses transition from point A to point B. When you blend it all together, we're able to achieve an asset yield on the portfolio, unlevered, north of 10%, and that can support a distribution in the double digits.
Great. And I want to talk about the capital structure in a moment, but want to just transition back to Phil. You talked about, Phil, the differences in the different structures, kind of the benefits, drawbacks. From your standpoint, what's really drawing investors to the space? Why are more, I read that statistic, but about 16% of all the funds coming in the past year. Why are more and more investors within this wealth segment gravitating towards the interval funds?
Yeah, from a demand perspective, right? You've seen, I think, two things, right? Private credit has really proven itself. And then the uptick and I think adoptability of the interval fund structure is the other one. And so private credit proving itself, yeah, I'm sure the audience has seen all of these charts, but if you look back over 10, 15, 20-year period and compare just the private credit beta, so largely speaking, just direct lending, just the beta of that market versus high yield and bank loans, so the public credit equivalents, right? You've seen about 3% of excess return on a net of fee basis over a period of time. And so if you're compounding that annually over 15-year period, that is a substantial amount of excess return. And that is something that historically, right, investors just didn't have access to in the segment in a fee efficient way. The other thing is on the risk side, right? Default rates and loss rates have been virtually identical between the private markets and the public markets. And so you're getting paid that excess return by giving up liquidity. And historically, that give up in liquidity was 8 to 10 years. Right now, it's just you're going from daily liquid public credit funds to quarterly liquid interval funds, right? It's quarterly liquid up to a point, but still the message holds where it's just a much more effective and efficient way to generate income. And so on the demand side, that's why you've seen, I think, the wealth segment adopted. And then on the structure innovation side, right, historically, you would have to invest in public BDCs or private BDCs, okay, which are limited, essentially just doing corporate credit, right, which is what private credit predominantly used to be. But now with the interval fund structure, you can open up the opportunity set. As Nick alluded to, they're doing a lot more than just, upper middle market direct lending. Our interval fund, CAPIX, allocates across the full spectrum of private credit, including the full spectrum of direct lending, but also real estate credit, real asset credit, specialty finance, and mezzanine. And so the ability to do that in interval fund structure really allows, I think, the wealth management segment to get a one-stop shop solution to the full spectrum of private credit, which they couldn't do with historical fund structures. And so when you combine those two benefits, we think this theme is honestly going to continue.
Thank you for that, Phil. And Nicholas, you briefly mentioned that the capital structure in your opening comments. How does the FS Global Credit tailor credit solutions across the capital structure?
Yeah. So, what we're trying to do is create an attractive instrument for our investors that also matches, the need of the borrower or the situation if it's a non-corporate type of investment. And we have the flexibility on our platform to do that. So, for example, if someone is looking for traditional buyout financing and needs a $200 million loan that is 50% LTV to support a healthy growing business that's being, acquired, we can provide that sort of solution. We have broad industry expertise, we have structuring expertise, and we have a home in our portfolios for that kind of, call it plus or minus S500, financing. Conversely, if you have a rapidly growing business that is cash flow negative because they're investing back into the company, but it's a very solid, healthy business, that could generate a lot of cash if they stopped investing back into the business, or had hard assets that we could lend against or something like that. We can create an appropriate solution for that kind of company where they're not going to have access to traditional debt markets, traditional private or syndicated credit. And, using our experience in structuring, a lot of the guys on my team have, sort of special situations, backgrounds. So are pretty sophisticated at coming up with ways to create downside protection, through structure. We can figure out a way to provide that kind of borrower, with capital at a cost of 12%, 15%, or maybe it's a hybrid instrument that has, a coupon of 10% plus equity upside that could lead to a return of 20, 25, 30% for us in a way that has downside protection.
Right. And you mentioned the word sophisticated. It's great to hear both of you, the experts, talk about these topics because they can get kind of in the weeds. And, from that standpoint, Phil, what additional skill sets do investors or perhaps advisors need to assess for interval fund managers? And how can we learn from some historical issues?
Yeah, I think the big thing, right, that makes interval funds different than the historical way of investing in private assets, right, is that you can subscribe to them daily and you get fully invested in a ramped portfolio virtually the next day, right? And so that is great from an investment standpoint, but from a portfolio management standpoint, right, that adds a new skill set from a deployment perspective where you have to put money to work effectively and efficiently, but remain disciplined, right? And so making sure that any manager that you're investing in on the interval fund side that can take in money daily, that they actually have an origination deal flow to actually put that money to work in a disciplined way, right? What you've seen in the market recently is that you've seen the top 10 largest managers take in 80% plus of the capital over the last 3 years. And so what that has done is that has strained their ability to maintain that discipline in our belief, right? And so it's really understanding, okay, how much money, like how much deal flow are you seeing and how much money do you have to put to work, and making sure that that ratio matches up to ensure that you're getting, high quality selection, particularly on the private credit side where you're just seeing less deals. In corporate credit, M&A has been a little bit slower, but you've seen a lot of capital raised over the last couple of years. And so I think keeping an eye on that, and then also liquidity management, right? You're offering quarterly liquid up to a point, and so you need to be able to hit those liquidity strains when they come. And so you always need to be ready to hit your 5% max liquidity every quarter. And so most of these funds should have at least a credit facility and then a liquidity sleeve to make up for that, so that you can conservatively always meet any type of max outflow situations for at least 2 years is kind of the norm. So those are a couple of things that I think investors should keep an eye out when they're doing diligence on these type of structures that are a little bit different than what you would do on the drawdown side.
Right.
Yeah, I think Phil makes some great points there. Just to tackle the same question with a slightly different approach, it's challenging when you're looking at the outside in at a fund. There is full disclosure on the portfolio, so sure, you can see the 100 line items and get a sense of exactly, what sorts of underlying risk you're stepping into. But, obviously it's difficult to do, thorough diligence on a bunch of private situations, that maybe 1% of a given portfolio. As a result, I think you have to really look at the managers' pedigrees, who are the people who are running the strategy, how long have they been doing this? What's their background? Is that, attractive? And then you can also look at their track record and see how the fund has performed. Obviously, with younger funds, that can be, somewhat of a challenge, but sometimes, managers have other kinds of vehicles that they've been, sort of responsible for. If I look at our team, we've been managing, one fund that's listed on the New York Stock Exchange, for the last 8 years. While this interval fund is something we've only been managing for a year, you could look at that other fund, which has a much longer performance history, and say, oh, okay, well, this is the sort of stuff these guys do. This is how they've done over time. So that can be a useful tool in manager selection and fund evaluation.
What makes the fund distinct in today's interval fund landscape? And from an approach standpoint, how does your approach and the deal profile differ in sponsor-backed transactions versus non-sponsor situations? Things like sourcing, pricing, and terms. How do they differ?
Yeah, good question. I mean, I think, listen, first and foremost, this is a people business. And so no matter what you're doing, who you're investing with is, ultimately going to be one of the more important things to consider. So hopefully we're differentiated because we're good at what we do. I think it starts with having access to a broad variety of proprietary deals. So to Phil's earlier point, sourcing is so important, and you don't want to be in an environment where you are opportunity constrained and therefore put in a position where you kind of have to say yes to things that you feel lukewarm, about. So we are extremely focused on running a business that has, a large pipeline of opportunities that we're working on at all points in time. Right now, we've got 91 deals in our private deal channel at various points of diligence or execution. So that is incredibly important. Looking at the asset class that we focus on, it is somewhat broad spectrum in the sense that we'll do sponsor finance, but we'll also do special situations, capital structure solutions deals. But that's attractive because you have a blend of, I would say, high volume, high quality sponsor-backed finance deals, which are lower middle market deals, where I think the terms are still better than you get in the broadly sort of larger parts of the market where that 80% of the capital is going to. So we can get a little bit more pricing, a little bit more origination points or convexity on the back end. We can get tighter covenants. We can get more due diligence information. So that's a very strong portion of our business, and then we can kind of complement that with these more unusual deals, which you would not see traditional private credit firms doing, where again, we're originating investments with a mid-teen type of return. And then the third leg of the stool is opportunistically being able to add risk from the public part of the market to Phil's point about having a liquidity sleeve and maintaining a part of the portfolio that can flex up or flex down in different sorts of opportunities. We do have a CLO business, and we do have guys with very strong pedigrees investing in opportunistic credit who can help enhance the fund's returns that way. So we cast a wide net. We focus on the lower middle market, which we think is a little bit less competitive, and have a portfolio which is a blend of different kinds of non-investment credit assets that can create some diversification and enhance return.
Yeah, thank you for that. And we want to talk a little bit more about private credit with Phil, and then with you in a moment, Nicholas. But Phil, what's your go forward market view across private credit? You think it's become crowded? Curious to hear your thoughts on that.
Yeah, I mean, there's a lot that we could cover on that. You've seen a lot of, I think, pretty scathing headlines in the media recently about private credit, even though a lot of those issues are on the public credit side, and that's not really getting reported on. But I would say going forward, right, what you're seeing, there really two primary dynamics, right? SOFR is starting to come down as the Fed starts to cut rates, right? And private credit is a floating rate dominant asset class. And so you are going to see yields start to come down. The benefit of that is that as rates start to come down, you're likely to see deal activity pick up. And so what you might lose in terms of, base rates, you probably gain in spreads. Okay. And so we think that, 2022 to 2024 was an unusual period where you were getting, 10 to 12% type yields for down the fairway type credit. Going forward, you're probably looking at 7 to 11% type yields in kind of senior paper, where I think the benefit of being able to flex, to Nick's point, outside of just doing kind of generic direct lending is going to be more and more important, right? Avoiding the crowded areas, avoiding the areas where you're probably not getting paid per unit of risk, right? Upper middle market direct lending is an area that does seem to be pretty crowded, right? And you're not seeing a lot of deals getting done there. There's a lot of consumer credit strains that we're seeing, right? You're getting a lot in the subprime auto. That's an area that we would probably look to avoid. And then the other one, as you're doing due diligence on private credit managers, like how much of their book are loans that were done pre-2022 Fed rate rises, right? If they were doing a lot of legacy originations, if they raised a ton of money in 2020, 2021, and thus deployed during that period, right? Those companies thought they were borrowing at 6, 7%. They've been borrowing over the last 2.5 years at 11, 12%. How sustainable is that? That's where you're seeing a lot of the amendments to PIK And so those are some of the areas that we think, there might be some red flags in, but there's $20 trillion in the areas elsewhere. And so being able to pick and choose and actually flex into the areas of the market that, again, are more attractive because banks are getting out of them, right? NAV lending, just generally asset-backed lending away from consumer, real estate credit and lower middle market direct lending are areas that we find still quite attractive.
Thank you for that, Phil. And go to this issue of Nicholas, different sizes of deals and market caps. What are the risk reward and control dynamics most attractive across different size tiers? Large cap, 1 billion plus, core middle market around 500 million, lower middle market around 200 million. When you look at those three size tiers.
Yeah, so I mean, I'm biased, but historically, you've seen better returns in the lower middle market than other parts of the industry by size. I'd say, at the larger end of the market, one of the challenges that private lenders have is they're competing with syndicated credit. And, the state of the syndicated credit market right now is pretty unattractive for investors. I mean, a B3 loan, that's getting issued, a $1 billion B3 loan is coming at S325, maybe even tighter than that. That has no covenants, and it also has extremely weak structural protections, that allow borrowers to move assets into subsidiaries that are, unrestricted in certain instances, or, get aggressive, with their creditors in sort of adverse, scenarios. So if that's an alternative for a borrower or company and you're pitching a private credit solution, it can be difficult to be competitive with that. So, in order to be competitive, you need to sort of be relatively easy to work with. And obviously, you're limited in your ability to extract excess spread and extra price. The lower middle market, typically borrowers are not going to have access to that syndicated market. You also typically get more information in the lower middle market than you would if you're looking at larger types of transactions. So you can do, a little bit of a deeper dive from a diligence perspective. So I think there should be higher returns. There should be a little bit more downside protection and a little bit more alpha, in the lower middle market. But, being honest, that's competitive too. I think the things that are less competitive, are the harder to find deals, the harder to do deals, the harder to underwrite and structure deals, like the capital structure solutions stuff that we, are focused on. That also tends to be a little bit less sensitive to changes in the rate environment. SOFR is, 2% versus 4%. The total return on those kinds of investments doesn't really move around as much as it does on, something that's more of like an S500, zip code piece of paper. So generally, I think that it's wise to have exposure to, to the lower middle market for slightly better risk reward.
Thank you. And we're doing pretty good on time, about 3 or 4 minutes to go. I want to give you each one more quick question. And this has been great. I'm learning a ton. So thank you. Phil, one final question for you, kind of looking ahead a bit. What's your view of private equity within an interval fund structure? And is that, kind of where we're headed potentially from your standpoint?
Yeah, I do think so. We talked about the rise of the interval fund structure generally. Okay. And a lot of that has been on the credit side, right? Credit is a relatively liquid asset class where, the average hold period for, your typical loan in private credit is actually 3 to 4 years, right? And so you have about a third of your portfolio rolling off naturally. Private equity is not like that at all. And so the way that most evergreen funds have been set up on the private equity side or in tender offer funds where you can actually shut off that liquidity every quarter. Well, I think what we've seen in the market is a lot of those tender offer funds realize that they don't want to turn off liquidity. And so they hold 20% in cash, right? So you're getting 80% private equity, 20% cash, not that interesting. And so if you do the interval fund structure, yes, you have to guarantee the liquidity. But if you move that from quarterly liquid to semi-annual liquidity, right, and you have the ability to toggle secondaries and direct loans or direct, positions in private equity, we think that is going to be the future. I mean, you've seen ourselves and a few other managers launch private equity interval funds with semi-annual liquidity. We think over the next 3 to 5 years, that is going to be the norm. And so I would just say, keep an eye out on that on the interval fund side.
Will do. Thanks, Phil. And Nicholas, we've got time for one more question. A couple minutes left here, sticking with this issue of private credit. When do you and the other PMs prefer private credit exposure versus public credit, and what are the trade-off for investors?
I've been doing this for a while, and, private credit has grown as an asset class and become a much more attractive place to deploy capital as it has grown, over the last 15 years. And public credit has not grown, or at least, in corporate high yield and loans has not really grown as an asset class and has become a less attractive place to invest over the last 15 years. So I would say at a high level, private credit has just become much more attractive in sort of absolute and relative terms. That being said, there can be moments in time where there are dislocations, in the public market. There can be forced selling, which can create some very appealing buying opportunities. And then obviously, you can originate assets in a discount in the public credit market a little bit more easily than you can in the private credit market. It is true that occasionally you can buy things below par in the private credit market, but there's usually pretty big information asymmetries that you need to kind of get over to make that appealing. So overall, private credit just seems to have a much more attractive risk return, but there can be moments in time where you can find good risk in the public markets. And so having that optionality is appealing as a business.
Great. Well, thank you, Nicholas and Phil. We're 30 minutes. This is exactly the discussion we wanted to have in the time frame that we wanted to have. So thank you to both of you, and thank you everyone for joining us today.
Thank you for joining us for another episode of CEF Insights. Visit CEFA.com for more education from the Closed End Fund Association. This material is not intended as investment advice, an indication of trading intent or holdings, or the prediction of investment performance. All fund-specific information is the latest publicly available information. All other information is current as of the date of this presentation. All opinions and forward-looking statements are subject to change at any time. First Trust, Calamos Investments, and Future Standard disclaim any responsibility to update such views and/or information. This information is deemed to be from reliable sources. However, First Trust, Calamos Investments, and Future Standard do not warrant its completeness or accuracy. This presentation is not intended to and does not constitute an offer or solicitation to sell or a solicitation of an offer to buy any security, product, investment advice, or service, nor shall any security, product, investment advice, or service be offered or sold in any jurisdiction in which First Trust, Calamos Investments, and Future Standard are not licensed to conduct business, and/or an offer, solicitation, purchase, or sale would be unavailable or unlawful.